Good afternoon. It is Sunday, November 2nd. We've finished October. That is in the books, and we move on to November. October and September tend to be seasonally months when you have stocks selling off. And I have to say, in 2025, we made it through both months, September, October, without too much damage. Both months were positive. In fact, October, looking at the 30-day, the S&P was up 1.86%, which is good. And we've had a lot of volatility for the last couple of weeks. But in general, especially some stocks are really flourishing. In this live stream, we're going to talk about stocks that are interesting to take a look at. Most of what I'm going to cover has been requested by members of the channel, and I've taken some requests already. Looks like the list is up to 5 stocks that have been requested. So I'll take a look at those stocks as we go through. We'll also take a look of next week for the earnings that are coming up to see what is going to be announced and see what's coming. Last week was huge. We had big earnings from Google, Amazon, Apple, Microsoft, Meta. And Meta probably did the worst. They probably got slapped around a little bit on Thursday, Friday. Their stock went down. And the 2 stocks that did really well, Amazon probably came out furthest ahead last week. They had a really good earnings announcement showing that their cloud business really grew and their stock flourished on Friday. The other stock that made it through quite well was Google Alphabet, that showed that their business is really thriving and their stock moved higher after that news. So this coming week, we've got a lot of stocks coming up. This year to date, the S&P is up 16.3%. The 1 year, the S&P is up 19.74. Hopefully you are doing better than those index returns. I know I am, and hopefully you are as well. Let me thank the newest member of our community, and it looks like it's Zaval Dorad, 1994. Thank you so much. You looks like you just became a member. Do me a giant favor. I put my email address on the chat. If you could email me to make sure I get you the perks that you get as a paid member. And thank you very much for your support. Looks like Peter is on the stream, and I noted, Peter, that I put CMG on the list, and we will get to CMG in the stream. Paul, good to see you. Let's talk a little Meta. I'd be happy to talk about Meta and talk about what's going on with that stock. It certainly sold off last week. Is it an opportunity? Is it a big problem stock? And, you're thinking along the right lines for next year. Very good. Think forward on Meta. It's a very good thought. I'm going to get to Meta. It is on the list. So we're up to 6 stocks that are on the list. The symbols I'm going to go over are URI, that's United Rentals, FI, Fiserv. Fiserv they got sold off, to say it politely. Eli Lilly, LLY, CRM, which is Salesforce, Chipotle, which is CMG, and then Meta is on the list. So we've got a nice list going, guys. Thanks so much for the ideas on stocks. So in general, let's take a look at a couple of things just to kind of get the juices flowing. We look at the most valuable stocks on the stock market. NVIDIA came down off its high horse. It was $5 trillion. First company to ever get to $5 trillion. Incredible. Took a small step back. It's doing phenomenal. Year to date, it's up 50.79%. Apple had okay earnings. The earnings were okay, but the stock is kind of okay this year. It's up about 8%. Microsoft, the earnings were okay. Stock sold off. There's a little bit of hard to read if maybe the market knows something I don't, or if the stock is just being punished for no reason. And then Google Alphabet had a nice week. It was down 10.1%. 0.4% on Friday. Overall, year to date, it's doing great. And Amazon had a great Friday, but it's got some catching up to do. It's only up 11.3% for the year. So Amazon's got a long way to go. Broadcom surpassed Meta, who just got shellacked this past week, going down substantially. So Broadcom is doing well. Meta is trying to heal from some pretty good wounds it took on Thursday and Friday. We'll see where it goes. We will analyze Meta. Tesla, I don't have much to say there. And then TSM is pretty solid. All right. Looks like Justin, good to see you. You put down a super chat. Thank you, sir. INTA, double down with earnings. Interesting. INTA. Let's take a look. All right. Thank you, sir. We got our first super chat of the session, and I appreciate it. Thank you. All right. So let me finish off a couple of things I wanted to start with, and then we'll jump into that super chat and then the list. All right. So earnings calendar. Tomorrow, big earnings from Palantir. Whoo-hoo. That's a big one. After the market closes. Then we got Vertex Pharma. The Williams companies, not quite sure what they do. Simon Properties, a REIT. Realty Income's a REIT. Ares Management is kind of a private equity kind of company. Diamondback Energy, I know what they do. So we've got a lot of interesting earnings coming out on Monday. That's tomorrow. Most of the big stuff's coming out in the afternoon. So it'll be interesting to see where those trade in the afternoon. On Tuesday, we've got AMD. Man, it's going to be big. After the market closes, before the market opens, Shopify, along with Uber. That's going to be interesting. I am a big Uber shareholder. I'm not a shareholder of Shopify. It always looks a little too expensive. They don't have as high enough margins as I would like from a software play. Arista Networks, that's looking interesting after the market closes. Amgen, that's a biotech company. Pfizer, big pharma. Spotify has been kind of beat up over the last couple of weeks. Its stock's really come down, and there was news that their founder is no longer going to be their CEO. So I think that has something to do with it. On Wednesday, Toyota, Novo Nordisk, AppLovin, that one's huge. I own AppLovin. We'll see what they report. They've been growing like leaps and bounds, man. AppLovin's really making it happen. Just the dominant force in ad tech. Incredible. McDonald's, Qualcomm, ARM Holdings. I mean, it just goes on and on. Robinhood. I'm a big shareholder in Robinhood. Looking forward to that. DoorDash has just been really operating so well and growing so nicely. So DoorDash will announce on Wednesday. And man, we've got a lot of work ahead of us, a lot of opportunity. Thursday, AstraZeneca, Airbnb, Monster Beverage, Vistra, which is in the data center. Incredible. Hood has been great for me. Absolutely. Hood has been awesome. It's been a stock that's been number one on my portfolio from a percentage return. I'm happy to have it. It had a really good week this past week, really good days. On Friday is the first Berkshire Hathaway. The investor letter is going to be created by the new CEO. So Warren Buffett has officially handed off that responsibility to the new CEO, and it'll be his very first letter. We'll see how the market receives it, and we'll see how they report on Friday. And looking at the others, Constellation Energy, that should be interesting. Energy companies have become really interesting. Enbridge Energy, Duke Energy. Wow, just a lot of stuff, guys. So we've got a big week of earnings in store. It should be a really interesting week. So, and it looks like Benton, you got a position in AppLovin. Just, AppLovin's been a tough one to buy into. It's a great stock. I own it. It just moves so darn fast. You would love a stock to kind of slow down for you if it can kind of give you time to buy into the stock. So, all right. So let's get started on some reviews of companies. And I'm just going to open up a new page here. All right. So what is INTA? So Intapp through its subsidiary Integration Appliance provides AI-powered solutions in the US, United Kingdom, internationally. It provides Deal Cloud that manages client relationships, prospective clients and investments, current engagements, as well as provides customer service management, deal management, experience management, and relationship intelligence solutions. The company also offers compliance products to help firms thoroughly evaluate new business. So it sounds like they're playing in the CRM space. How are they different than Salesforce, which in my book is the big player in this space? Let's take a look at their products a little more. Deal Cloud, CRM, business development. Okay. Then they do compliance. And what is compliance? So you're trying to identify conflicts of interest, huh? Okay. I know that's a part of the, I guess, the deal management process. These guys really go all the way with it. That's interesting. Okay. And then billing. Okay. So this is in the CRM space. And where are these guys located? So they are in Palo Alto. Okay. All right. So there's a software company within the CRM space. Now, it is a bit of a crowded space. You have CRM Salesforce, that's the biggest company in that space, but you have a lot of players in that space. You have ServiceNow. You have a long list of kind of small players. We'll see where these guys stack up when we look at their fundamentals. So their market cap is $3.14 billion. Okay, revenues of $504 million. Forward P doesn't look too bad at 32.5. Analysts think it's really expensive. Now, what I've observed is the software space isn't getting much love. The software space is a little bit under kind of a guilty until proven innocent situation. The market believes that AI is going to disrupt, and it's not clear how, software companies. I think a couple of things that could be threats is it's expected that software is going to be easier to develop in the future. So these complex companies like Intapp or Salesforce or ServiceNow are not going to be as valuable. I guess their moats, their competitive advantages and barriers will be lowered. That's a theory. I don't agree with that theory, but that's a theory that's out there. Second is, well, will AI, through the use of agents, lower the need of a CRM platform? Maybe you have fewer employees working for your company because you have all these AI agents going after or taking care of maybe the smaller issues, less complicated items. When it takes that volume off, you need fewer employees. Fewer employees means fewer licenses for companies like Intapp. So those are theories at this point. I'm not seeing it be reality. And when I say reality is if I look at Salesforce, they're growing, and they actually came out about a week and a half ago and they gave a 5-year forecast showing that, hey, we're going to be growing for 5 years. So this whole story that AI is disrupting us, it's really a fictional story because we aim to prove that we're going to actually continue to grow. Let's take a look at the fundamentals for Intapp. So these guys are growing nicely, but this isn't incredible, okay? This is a small company. And I'm going to open up CRM just so you have CRM and ServiceNow, because what we want to do is we want to compare what are the choices we have in investing, right? We don't have to buy one stock. It's not a rule that we have to buy a particular stock. And I want to make sure that I make the best investment that I have available to me. So these are two powerhouse CRM companies. ServiceNow, these guys are growing at 22%. And Salesforce is much larger, and they are growing at 8.7% for the last fiscal year. And then previous years, they were growing at 11 and 18. So when we look at Intapp, if you recall just a second ago, I said this is not incredible growth because ServiceNow is actually growing much faster than they are, and ServiceNow is much larger than Intapp. Salesforce is humongous, $38 billion in revenue, while Intapp is only $500 million in revenue. So I just want to point out that the growth isn't really incredible. Let's take a look at margins and see if they're producing free cash flow. So the margins are very good. This is a software company. Software companies produce really good margins. And the free cash flow is good as well. $121 million. At the growth rate with margins that I'm looking at, I would multiply this times 25 minus debt. So 25 minus debt, it's going to get us to about $3 billion minus debt. And how much debt do they have, if any? Looks like they do not have any debt. They have cash. So you'd actually add the cash. So $3.3 billion is where I would value this company based on their free cash flows. And they are at $3.14 billion. So not a lot of discount for a small cap stock that is, I would say, a risky stock because they do things that might be a little different. And I know that the whole compliance play is a differentiator because I don't think Salesforce does that a whole lot. And I don't think ServiceNow does that a whole lot. But if Salesforce decided to really get their heads around compliance, maybe they go after Intapp's market, and that'd be a big threat toward Intapp. So this is not like a low risk investment. It's actually a pretty risky investment when you invest in a small cap that is really encroaching on these big competitors that have a lot of power, have a lot of smart people working there, and they will probably want to go after your marketplace. So we have 8 analysts covering Intapp. $75 per share is the high stock price target, and then the low is 43. So everybody's pretty positive on this company. So that's good. Let's take a look at the growth. So again, the growth is not getting me excited. It's a small company. If you're small, you have to grow fast. If you don't grow fast, to me, it's just not exciting. It's not going to grab everybody's attention. It is going to be a good company, but if they get into a slow growth mode and they're still small, they're not going to be worth a whole lot. Earnings per share, looks like they have a fiscal year that ends June 30th. So we're in this fiscal year that I'm pointing to, and they're going to have $1.13. Okay. And based on that valuation, you'd have to pay a forward P of 33. Let's take a look at, again, CRM and ServiceNow. What kind of PEs do we have to pay for those companies? And when we look at Salesforce, we are in this year 22.67, and then next year 20. So you'd have a much lower PE with CRM. ServiceNow, we would have or analysts, with ServiceNow, the PE that an investor would be signing up for, I'm going to look at next year's 45. And ServiceNow is growing the fastest of the 3 stocks we've looked at, and ServiceNow is much larger than Intapp. You see, this one's 11 billion, Intapp is 500 million. So this growth looks way better. So in general, I'm not a buyer of Intapp. I'm just not seeing enough. And did these guys IPO recently? Or I've never heard of this company, and I'm pretty familiar with this space. No, they've been around for a while. So it looks like over the 5-year, investors would have made about a 47% appreciation. But the market for the last year, they've said, this stock is priced too high. And basically, it's sitting at about a 50% haircut from the high. So overall, this one here would be a pass. It would not be a buy for me. And yeah, they announced their earnings. Yeah, I'm not seeing high enough growth. I think it's a good little business, but boy, they're operating in a space that's pretty crowded. The CRM space, a lot of good competitors in there. You're going to have to compete against some of the best companies out there for software. So thanks for sponsoring that super chat. And I hope you found the analysis interesting on Intapp. Justin, I think you're a return guest or a return attendee, I should say. Thank you so much for sponsoring that super chat. That was an interesting little company. All right, let's keep moving. Let's keep moving here, and I'm gonna hold off from reading the chat because it's kind of getting pretty active, which is awesome. Keep it coming. I'm gonna move on to the next stock because we've got our work cut out tonight. United Rentals. So this was a request that I got, and United Rentals, they through its subsidiaries operates as an equipment rental company. It operates two segments, general rentals and specialty. The general rentals segment rents general construction and industrial equipment, includes backhoes, skip tier loaders, forklifts, earth moving equipment, material handling and equipment. Got it. So to get a visual on the business, if you have a construction project, you're probably going to rent stuff from these guys so you can temporarily use their equipment to build. You might even, if you're doing like some type of interior remodel, you might need their equipment. So that's what they do. They rent out equipment, variety of things that you may need. They'll rent them out to you. And I think it's a company that probably does well during economies that are growing, where you have a lot of construction and so forth going on. Year to date, the stock is up nicely, 23.67 for the 1 year. It's up 7%. So it's interesting that when you buy makes a big difference. If you bought, some point at the low point this year, boy, you're doing really well. You're up nicely. And it has had a pullback in the last month, a pretty good one. It was at $1,020 per share. Now it's down to $871 per share. These guys are $55 billion in market cap, revenues of $16 billion, PE 22.43, and forward P is 19.25. The dividend is small dividend, 0.82%. Analysts think it's a buy, discounted by almost 12%. So the growth looks pretty good. We've got 7% growth in 2024. Let's go trailing 12 months. The trailing 12 months growth is 6.73%. So it's single digit, 6 to 7% over the last 5 quarters. So that's decent growth for a mature business that's growing at that rate. That's respectable. Let's take a look at some profitability for the company. Free cash flows look really good. $1,929 million. Gross margins, they're renting out equipment, so there's not a lot of, it's not like the software company we just looked at. 39% gross margins. Profit margins of 15.8%. Free cash flow yield of 12%. All right, so these guys, in my book, these guys are worth about 15 times free cash flow. On a good day, maybe 20. And either they get to 30 or $40 billion of value minus debt. Let's take a look at their debt. Their debt level, they have $15 billion of debt. So this one here is a showstopper for me. It's an interesting company, but you're dealing with a business that's driving $2 billion of free cash. It's growing a little bit. So maybe if I gave them a pretty generous valuation of 20 times free cash flow, that'd get me to 40 billion minus that 15 billion of debt, brings me down to $25 billion of value. Well, it's what much higher than that. And look at this stock price. Why is it so high? This is a low margin company that has decent growth, respectable growth, but nothing exciting. There must be something that investors are thinking these guys are really going to do well. Maybe the whole data center build out. They think, whoa, these guys are really going to boom with renting out equipment as they build those data centers. And that might be the case. We study the quarterly. It's not showing up yet. 6% growth is not, incredible. And this is as of September 30th. So this was just reported. So the market may have a story in its head that, oh, these guys are going to grow really fast, but I'm not seeing the growth. In fact, it's slower growth than a year ago and especially 2 years ago. So if anything, these guys are slowing, their growth rate is slowing down. So this one here would be a pass for me. There's no way I can get to a valuation of this amount. And I'm not looking for slow growers that are priced too high. I'm looking for growth companies that are priced right or maybe at a really good discount because they're misunderstood. And this one is not it. So URI is a pass. United Rentals, it's not going on my portfolio. All right, let's keep moving. And we're going to go to Fiserv. Now, Fiserv, boy, they fell off a cliff. They had an earnings that was maybe the worst earnings of the season so far. And they went from $126 per share down to 66 in very, very short period of time. So losing almost 50% of your stock's price is not good in any book, right? Market cap 35.87. And I'm sure I've been asked a few times by multiple people, is it now an opportunity? Maybe. But let's study the situation. Stocks don't go down that fast unless there's some real facts that should be studied, because to me, it's very concerning. Investors don't sell off a stock at this rate. There's a lot of smoke. There's got to be some fire. Okay. It's not like, oh, market doesn't understand Fiserv. So let's get into it. Market cap, $35.87 billion. Revenue, $21.16 billion. We have a low PE ratio of 10.29, forward P of 8. Analysts think it's wildly discounted. All right. Let us be the judge of that. So the revenue for the last year, the revenue was at 7%, and they came in and announced a quarter where they had very little growth, barely 0.92%. So I think that's what really alarmed the market. Slow growth, bad guidance also came out. And this is the payment processing. This is a fintech company. And in this business, if you're not growing and somebody else is, that means they're taking share away from you. They might even be taking your customers away. So I think that's what really radiated through the market, and the big sell-off was on for this company. When we look at their free cash flows, let's take a look at that. Free cash does look good. Okay, free cash looks actually fairly darn good. We go trailing 12 months to get an annualized figure there. And free cash flow is $4.6 billion. Now that growth, if you're a 0% grower, I've seen some payment processors like GPN, it's gone nowhere. That stock's bumped along the bottom. And, I wouldn't want to buy stock like that because it just becomes a giant distraction. And I just don't need that. I need to go find great companies that are going to be worth a lot more going forward. So, but the cash flows do look good. 4.6 billion is a lot of money. Free cash flow yield of 21.8%. It is a profitable entity. It's just that growth number that's really making everybody nervous. So if I went 10 times free cash flow, I get to 46 billion. And I think that is above its current market cap. So that's interesting. Let's take a look at their debt. Do they have any debt? They do. Oh, man, look at all that debt. $30 billion of debt. Why do you have so much debt? Geez, that's too much debt. Way too much debt. And debt to EBITDA 3.23. Man. So I thought this stock would be worth about 40, maybe $50 billion. If they were growing, they'd be worth more. But minus that debt, we're down to $25 billion in value. So this one here, this is a sick puppy. Is this going to come back and be worth more? If they start to grow, the answer is yes. But I don't know if they're going to grow. This is a very competitive market. You have companies like PayPal, and you have a long list of payment processors. So if you're losing momentum, it may be because your competition is just better. And if your competition's better, how are you going to beat them? You're going to have to figure out how. And at this point, I don't think the market is confident that Fiserv is going to figure out how to grow. When a company stops growing, it is rare. I would say it's probably more often you see those companies become dormant, become less relevant, no growth. Every once in a while, a company kind of touches the zero growth and then starts to grow again. That would be exciting, but I'd have to see another earnings or two where they do prove that they're growing. Because if they come back and they show very little growth, the market's going to be right. This stock should be priced down. It was priced too high to begin with. Look at this stock, really ran up. People were excited about it. Looks like beginning in 2023, they really went up to $235 per share. And now they're down to $66 a share. Wow, what a drop. And this happened in 2025. So buying healthy, strong companies is really important. Fiserv is not a strong company. They're showing real big signs of problems. You have to keep growing. Growth will tell us, is the company's products desirable? Are their services desirable by the marketplace? Are they getting new customers because they do a great job? They sell a good product. Are the customers buying more of their services? And for Fiserv, the answer is no. And meanwhile, PayPal did have a pretty good growth number. PayPal's pretty big. Visa had a good growth number. So their competitors are showing good performance, but Fiserv's not. So for now, Fiserv, it is not anywhere near my portfolio. I'll give it a quarter, maybe two. We'll see if this sick puppy can come back to health. But I think that Fiserv at this point, unless you know this business super well and you feel very confident that, hey, they're going to make it back. It's just a bad quarter. They're going to make it back, and everybody's going to be amazed in a year's time how good these guys are. Well, if that's your, starting point, good luck. You've got an information advantage. But if we're left to process the information that's being provided to us, I think this company, this stock is going to be pretty much doing nothing for the next year. And we'll see in 3-4 quarters if it's going to go higher or if the market was absolutely right in pricing down this stock. Let's take a look at the forecast. This stock got 27 analysts, and some analysts are like, man, this thing's worth so much. I think these analysts got to restate their price targets because they're way off. Even the most bearish price target, you would think that they'd remove their price targets immediately on a stock like this because they're losing credibility. So these guys that are, even the top analyst here, they're probably losing credibility. This guy maintained and he did it October 30th. All right. Oh, wait, he moved it. Price target went from 128 to 75. So you see that there's been a reset on where these targets were. So this guy is showing that, hey, this stock really should be priced down. Now the stock is supposed to grow. If they grow at 8%, this could be an interesting stock to invest in. For now, I don't know if they're going to grow at 8%. What happened with this quarter? You'd have to study the earnings, study the listen to the call, and establish your confidence in this company being able to grow at 7.9%. If the confidence is there, maybe you've got an interesting idea. If there's no confidence there, for me, I'm not touching the stock. I've got other choices that I'd rather make. This is a very competitive market, payment systems. There's a lot of players out there. You're going to have to compete against some pretty bright new generation, old generation. It's a dogfight out there for fintech. So that is Fiserv. For me, I'm staying away. It'll be interesting to see if they come back or if the market got it right. The market thinks this stock should be priced way down. We'll see if the market's right. Or, investors that believe in Fiserv may be right, but they're waiting 2-3 years for this stock to come back. That's not what I want to do either. I don't want to sit on a stock and just let my capital just sit idle for a long time. All right, so that's Fiserv. Let's move on to Eli Lilly. Eli Lilly had a very good earnings. They're performing well. The year to date, it's a decent number. They're not keeping up with the S&P. The 1 month, very good number. 1 year, not good number. The 5 year, excellent run company. They are the biggest healthcare stock on the market. And these guys are a market cap of $772 billion, revenues of $59 billion. And the PE ratio is 42, moving to 28.99. Strong buy. Let's take a look at their financials. The revenue growth is really good for the last year. Let's take a look at the trailing 12 months and then the quarterly. Let's look at the quarterly first. Man, look at that revenue growth, 53%. Nicely done. Very good growth. So this is very good growth. And let's take a look at their margins and then their free cash flow generation. So their free cash flow is $9.2 billion. Big number, 9.2. Wow, that's really good. Gross margins of 83%. Very good. Profit margins are very high. Free cash flow yield is very good. Now, one of the things that I find it hard is this is $9.2 billion. Based on that growth rate I saw, maybe I go 40 times that number. And if that's the case, then I'm up to $350 to $400 billion. That's a big number, but these guys are even higher than that, 772. So, man, it's really hard to price Eli Lilly. Every time I try to do it, I never get there. So the free cash flow last year was really low. See how it's been all over the place too. They're not a proven cash flow generator like other businesses are. Looking at the forecast, these guys are followed by 14 analysts. The most optimistic believes this is a stock that's worth $1,190 per share. The worst stock target is $700. So it's just a nice discount of 12%. This hasn't been a great performing stock, but you see that they're going to have good growth going forward. And their PE is going to come down. Now, I always have a hard time pricing this particular company because of their cash flow. Their cash flow doesn't give me a very good valuation. The best I can get to is like 400 billion plus cash. And I don't know if they have cash or debt. Yeah, they have some debt too. So Eli Lilly is just not there. It's just not priced right. And they are growing really well, but it's not the right investment for me. The stock has really had a hard time once it got to this high price. For the last 2 years, the stock's pretty much gone sideways. It cannot go any higher because I think the intrinsic value is put a ceiling on this stock. So Eli Lilly, not a good stock for me to buy. Now we'll move on. All right, let's keep moving. Let's hit CRM, Salesforce. We talked about it a little earlier when we talked about Intapp. And the reason I wanted to talk about it is this stock's been moving higher. And this is one of the stocks that's caught in that story that AI is going to hurt software companies. And it's a story, it's a theory. I think it's a theory that's incorrect. I don't think AI is going to hurt these software companies, or if anything, it's going to make these software companies, change over the next 5 to 10 years. But for the next couple of years, I think it's business as usual for Salesforce. They've been getting things done on their side. This is a $248 billion market cap company with revenues of $39.9 billion. So you're paying less than 10 times revenue for the company. PE ratio 38.8, moving to 21.77 next year. Next year is around the corner. We're already in November. Next year is a couple months away. Analysts believe there's a discount of 26.8, and I agree with that. I have Salesforce discounted. This is a big revenue company growing at a very good clip. When we look at the quarterly, look at that growth, almost 10%. That's really good. And Salesforce came out and put a 5-year growth forecast, and the forecast calls that they're going to keep growing year after year. So I think CRM is being priced at a big discount. It's all about, do you believe the market's going to realize that, hey, it's making a mistake on Salesforce? It really should be priced higher. The free cash flow on Salesforce, look at this big giant number, $12.4 billion. This is higher than Eli Lilly that we just saw. And Eli Lilly has a market cap 3 times bigger than Salesforce, but these guys crank out more cash. Interesting, huh? 77.65% margin, gross margin, even profit margin looks good. The free cash flow margin is excellent at 31.6 because these guys are a mature software as a service software company, and that's a very lucrative business. Analysts, collectively, they believe it's discounted by 26.8%. The worst price target that on the stock is $221 per share. Isn't too far from its current stock price of $260, but the high is $430. So there's really good upside in the stock. It's expected these guys are just going to keep growing. This is a very, very good growth number on a big company. So that looks really good. So Salesforce for me is a good stock. Good stock to invest in. I already own it. And I think I'm in the mood to buy more Salesforce this week and next, because I think over the last 30 days, it shows that the stock has been getting more investors, getting more people to buy the Salesforce stock. So that's looking really good. And look at the PE way down here, 22, 20, 17, 15. I think the stock's going to move higher, and the PE will stay in the mid 20s. So Salesforce is looking like a really nice opportunity. Let's take a look at their debt level to see if they have a high amount of debt. They do not. They have more cash than debt. That's a very good sign when your balance sheet has lots of cash and you're very strong. So Salesforce is looking really good. Salesforce has had a lot of doubts, but I like what I'm seeing. I'm liking this little rally here. If they can keep that going, I think this stock can definitely get back to $350 per share, maybe even go higher from there. So go Salesforce. All right, let's talk burritos. Let's talk about Chipotle Mexican Grill. Now, the problem I have when I talk about companies like this is I always get an appetite once I'm done. We'll see what happens on this occasion. This stock's down 47.45%. Jeez, what a sell-off. And it's a $41.9 billion market cap. Now, this stock, had a really nice rise from 2023 up to the high of $64 per share. But guess what? The party's over. We're back down to 31. So if you stayed long, like what's that famous investor, Bill Ackman, he was in the stock way back here, and he took the elevator up, and now he's taking the elevator down. So we're down to $31.69. What's going on at Chipotle? Well, the PE is 28.07. Forward PE is almost 27. Analysts think it's highly discounted. Well, let's take a look. Now, they've had good growth, but let's look at the quarterly. So growth is slowing. You see how they were really growing 15, 14, 18, 13, 13, then 6, 3, 7.5. This is what the market's really, not liking. It was priced at the previous high price. It was priced as a stock that was growing in the mid to high teens, 15 to 20%. Now it's going to be a slow grower, different valuation. So that is not looking good. Now 7.5 is respectable, but let's take a look and see if maybe this is a good value stock to consider. So 42 billion market cap. When we look at their free cash flow, 1.5 billion. You see, here's why I don't like restaurants. They have not raised their free cash flow amount per year in a long time. You see, this is per quarter. Is this per quarter or trailing 12 months? No, that's correct. So it follows each quarter. Let's look at the annual here. So free cash flow. They were growing it, and this is where the market paid attention. Like, whoa, you're really growing it. That's good. The revenue growth got people excited, but now the revenue not growing is making investors very nervous. So this is a restaurant, slow grower, 1.5 billion. It's Chipotle. What do their margins look like? 40% gross margins, not very good. Profit margins, 13%, respectable. Free cash flow yield of 13.3%, respectable. But low growth, low margins overall, low gross margins. So this one here is maybe on a very generous day. I'd probably say it's a $30 billion, 20 times, 1.5 billion. It's a $30 billion market cap value company minus debt. And do they have debt? They have a little bit of debt, about 3.5 billion. So we're talking about a $27 billion value company. And we're at $42 billion market cap. So this is a no-go. This is not a stock that I would ever touch. Restaurants are tough. Restaurants, you don't get a competitive advantage. Chipotle does not have a patent on burritos or tacos. It's a decent place to grab a quick bite to eat. It's this whole quick serve convenience. Got it. But man, there's new restaurants coming up every day. And Chipotle is not one of my regular restaurants because I don't think it's all that great. Sometimes you show up to the restaurant and the whole food section where the people making the burritos, it's not very tidy. And I don't want to say that it's dirty. It's just messy. Like there's food ingredients all over the place. And it's like, geez, because they're busy. I get it. It's hard labor. I worked at a restaurant when I was a teenager. I know how hard those folks work. I don't want to say anything discouraging about it, but it's just, the appeal to the customer. To me, I like to see my food be prepared under very clean conditions that are organized. And sometimes Chipotle's, they look like a mess. So Chipotle, complete pass. No, thank you. Maybe it bumps up a little bit, 10, 20%. Investors get excited. But long-term, this thing isn't going to be worth much more. It was a winner for a while. It rallied higher. I guess if you would have bought it way back here in 2017 at $6 a share, you would have made some money. But guess what? Those days are over. This thing has come down. Wishing that we can go back to this kind of rise is basically that, a wish. I don't think it's very rational. For me, restaurants rarely make it to my portfolio. It's just a tough business, low margins, hard work. There's always new restaurants coming out, really competing to get share in this category. And let's think about delivery, right? Food delivery now opens up so many restaurants. So Chipotle is a complete pass for me. So I think it was Peter that asked about that. So Peter, there is my conclusion on Chipotle. Let's take a look at Meta. Meta had a tough week. It had a tough week. 5-day down 12%. That's not good. When they were a $1.8 trillion company and they lost a lot of their market cap. The story on Meta is basically they're spending too much on that data center and they don't have anything to show for it. They have pretty positive stories that, oh man, we have the highest, I think they call it a concentration of talent around AI. Well, that doesn't mean anything. Show me revenue, show me profits, show me cash flows. That's what means something. We're talking business here. We're talking about businesses that drive revenue. So Meta got really asked a lot of questions. I listened to the whole earnings call. I read their earnings report. I created a video to members, and basically Meta had a bad week. And I hope they got the message that they have to stop spending so much darn money in the data center, because the increase in spend in the data center for them is very extreme, like tripled the amount they invested compared to last year. And they don't have anything to show for it. It'd be one thing if they showed, oh, we created some revenues out of the AI business. But the answer is nope, they don't have that. So no revenue means that you're just kind of burning capital. It's not good. Investors did not like it. They sold off the stock. And I hope Meta leadership got the message, stop spending so much CapEx. The core business is doing great, okay? But we cannot lose sight of when a company is doing something wrong. I'm a huge Meta stockholder, so I'm not just banging on this stock for no reason. But you're growing the business really well, okay? You know what? You're masters at social apps. You're masters at it. Stick to it and be careful with your capital expense, because it's really making your stock riskier. They issued out $30 billion of debt. You don't need to issue out $30 billion of debt to spend more money on the data center. That's kind of ridiculous. And the revenue is going to continue to grow. It's a big, big company, $200 billion in revenue already, growing at 16, 14, then 12. That's really good. Earnings per share has really expanded really well. And then the forward P is going to come down unless their stock price continues to go up. I think if the stock price will go up, so long as they got the message that they can't spend like they just have no limits around the data center. They have to either know that they can deliver some real growth, real return on investment, or stop spending so much CapEx. If they stop spending the CapEx and they keep growing the core business the way they're growing it, stock's fine. It's going to go to $1,000 a share. But if they come back with another earnings and try this, we're spending a lot of capital with no real benefit to show you in the form of revenues, the stock's going to sell off again. And then we're going to have a bigger problem on our hands, which is the company really intending on taking big losses on the stock price while they try to pull off this AI business, which frankly, it's really unproven how these businesses are going to make money on AI. It's really unproven. It's all a big chemistry experiment right now with AI. These businesses believe they need to stay out front, but there's no real business. OpenAI has revenues, but they are taking massive losses. It's one thing if you have a business that's showing margin, gross margin, but we don't even know that about OpenAI. We know that they have like $13 billion of revenues, but they're taking like massive, like 10, 20, $30 billion losses each year. It'd be interesting to see their financials to see what kind of money is involved in this AI business. So Meta had a bad week, and hopefully they got the message, and hopefully we're going to see this stock rise. It could rise to $1,000 a share, so long as maybe we hear some messages from Mark Zuckerberg and other leadership showing that, hey, you know what? We are gonna pump the brakes on capex, and we're gonna stick to our core business and really make that fantastic. We're gonna invest where we are seeing value come out of that business. So that'll be interesting to see. What was the analyst? I forgot to cover that. So we have 43 analysts covering this stock, and they think it's a 26% discount, which is a pretty decent discount on a big cap. But again, it's all about, is Zuckerberg going to start to socialize with the market that, hey, you know what? I got the message. I'm not going to spend, just endless amounts of money on AI without showing true value. We'll see. We'll see. So that is Meta, stock number 7, if I counted correctly. Now it's time to go back to the chat, see what's going on the chat. Looks like a lot of people are on. Thanks, everybody. Thanks for tuning in. All right. So, Paul, you're going to keep an eye on Uber on Tuesday? Absolutely, man. Uber has a terrific business, and they are in a very good position to, bring in the whole robo-taxi business. But so long as they just keep growing, they're going to be fine. And I too look into that. Look forward to their earnings on Tuesday. So Big House, good to see you. Hopefully you found my Meta review interesting. I also provided a video to members. I'm seeing a lot of members here. Many of you will have access to that video. Hopefully you found that interesting. So all these members, you guys could take a look at my video. I produced it on Wednesday afternoon. So take a look if you want deeper analysis on Meta. I pretty much looked at their entire financials. I reviewed their earnings call. I listened to their earnings call and gave you a full analysis there. And Peter, for me, Chipotle is a complete pass. I am not investing in Chipotle. It's not a business that I want to own. All right, so that is Chipotle. Chipotle used to great. I don't quite get that message. I don't know if I'm understanding it right. So Upwork is announcing, man, that'll be interesting. If those guys can grow, I really like that business model of, the gig worker, the gig economy. But we got to get that stock to grow. I should say the leadership over at Upwork, if they can figure out how to grow the business, man, that is going to be a really valuable company. But look at these 2 quarters at 0.94% growth. What is going on? You're in a new area of people finding, not necessarily employment, but they're finding income. You got Uber drivers, you got delivery drivers. Well, why not gig workers that actually do tasks or can do certain project-based work? I think it's a brilliant idea, but these guys are not able to grow, which is kind of a head scratcher. I'm like, why are they not growing? So that's one of the problems I see with Upwork. They're going to announce on the 3rd. That's what I'd be keying in on with Upwork, is their revenue growth. Well, you can double down on Meta. I own a lot of Meta. I'm not selling any of my Meta shares. So that's kind of a conviction on the company overall. I like Meta stock. I'm going to hold my Meta stock. I just think that we had a rough week. We had a really rough week, and we need to see Zuckerberg kind of communicate with the owners and listen to how concerned investors have been, both in the questions they asked during the earnings call, as well as where the stock went. The stock got shellacked in 1 week. If you want more of that, keep saying what you're saying, Mark. Or if you want a more prosperous outcome, listen to investors, listen to owners of the company, which are the stockholders. Yeah, this whole AI thing, we're in an AI bubble, and it could take years for it to stop. So it's not like, oh no, we're in an AI bubble, it's going to explode next week. No, it could be like 2-3 years before we really have big problems. But it creates situations like that where you have a lot of money being poured into something without much value coming out of it. And that's concerning. That's concerning as an investor. I think we're eventually going to have to pay the price for that. But for now, the market's going to go higher, in my opinion. So right now, the government shutdown is not having much an effect, but I think it's going to start to get uncomfortable. And I think it'll probably get settled, the shutdown this week or next, because there are some services to citizens that are being unmet. And I think that really cost votes to these politicians. So they're going to begin to really hit the panic button and say, hey, we got to get this thing resolved. If not, we're going to lose a lot of votes. And they don't like that because they're politicians. The other thing too, from a healthcare perspective, it looks like the Democrats are sticking to their guns and forcing the government to fund the Affordable Care Act. And if they do that, that's going to really help healthcare insurance companies as well as healthcare companies that provide products that those dollars are going to be spent on. So I think healthcare, if you get the shutdown put to rest and the government funds the Affordable Care Act, then we're going to see a nice rally, a nice tailwind to healthcare stocks. We'll see. We'll see if we have a sell-off. I thought we would have a sell-off September, October. We had a couple bad days, but nothing like no negative trend. Like we had a really bad Friday 3 weeks ago, and I thought, whoa, that caught my attention. We've had like a bad day, but no real follow through on a sell-off. And I showed the chart at the beginning of the stream where for the last 30 days, the S&P is actually up higher. So it's looking like, hey, we're just going to go higher with lower interest rates. I think we're going to go higher. So that's my expectation out there. And this is what I was referring to. The S&P for the 1 month is up 1.86%. Year to date, it's up 16.3%. So all those things just show me that this thing is going to go higher. Fubo TV, yeah, these guys, they're going to finish their merger with was it Disney, and then it's going to be a nice windfall for investors. Yeah, definitely. So you want to look at Opera after they announce, right? So when is Opera gonna? So Opera is a good browser business, and they're going to announce October. They announced October 29th. Yeah, well, let's take a look at it. So these guys, they provide a browser, and this browser is probably popular in Europe. This company is located in Europe. And if we look at the stock year to date, it's had rallies with sell-off, rally, sell-off, right? And this last sell-off has been kind of nasty. Look at that. So buying this stock at the right times, which right now doesn't look like a bad time. Let's take a look at their revenue growth and so forth. October 29th, when we look at their quarterly, 23% growth. That's very good. A little slower than the previous quarter from a percentage standpoint, but the compares are getting a little more difficult. So I think 23% growth is good. They have very good margins. Free cash flow margin of 90, and this is trailing 12 months, right? Yep. So free cash flow of 94.9 million. I call it 95 million. And they have been growing it steadily over time. They have decent gross margins, decent profit margins, and a good free cash flow yield. So with this growth rate, these guys are worth at least $2 billion, maybe $3 billion minus debt. And I don't think they have any debt. They do not. They have $110 million of cash. So this one here, it's a stock that I own. And I don't own a lot of shares. I don't have a big position, but I just think it's a really nice stock. And you think about these AI companies that would love to have their own browser. They could acquire Opera. They could acquire Opera and immediately have a browser. And this is a pretty decent browser. They are an alternative to Chrome and other browsers. Of course, Chrome is the dominant browser, but these guys here, with that growth, it shows that they're doing quite well. So for me, I'm a buyer of this stock. I already own it, and I am happy with it. The price targets for the stock, 5 analysts are covering it, and they think it's really discounted. And I agree with them. I agree that this stock is discounted. That's why I own it. And they're going to keep growing year after year. So Opera is a small cap. We've had, in some cases, especially the software space, stocks really sell off. It's just what we're dealing with. We're dealing with a market that's really buying into the data center, semiconductors, data center services, cloud infrastructure companies, and a couple of other spots. But for software stocks, it has not been a very good market. Salesforce, Opera, other software companies like Adobe has really had a miserable couple years. And it's that the market's not buying into software. So I'm being careful not to buy too much and just wait for the market to begin to rally around software, because it has historically been a terrific place to invest, where a lot of profit is made, a lot of cash flow is generated. And these companies really are valued very high because of their fundamentals and their intrinsic value. So Opera looks good after their earnings. It looks really good. And it has had a bumpy ride, but it's a little bit of, for example, ServiceNow will probably show this. It's down. So you're growing your business 22%, 23%, 22%. You're making money and your stock is down. How is that possible? But that's because the market's really not appreciating software companies right now. Adobe's even worse. Adobe's growing their business, making lots of money, lots of free cash. They even had a special day this past week, I think on Tuesday, where they were really showcasing how they're going to grow in their new businesses. They're growing almost at 11%. They're a pretty big company. But if you look at their stock, it has been selling off. So software space is not getting a lot of love by the market. So those are my comments there. Awesome. So we have 40 attendees on the stream. And thanks again, Justin, for buying that super chat. Really appreciate it. And I appreciate that you're a return attendee, showing a lot of interest in the channel. It'd be great to get you as a member, by the way. If it just costs a little bit more than paying super chats, and you can be a member. So this is our newest member, Osvaldo 1994. Thanks so much. Please get me your email address. You can email me at victorhinvesting@gmail.com. I'll get you a list of all your perks, and I really appreciate it. All right, guys. So let's end it there, and let's see what this week has in store. We have a lot of earnings coming, so I'll be sure to create videos for members, and I release videos to members first, and then maybe a month, 2 months later, I release them out to general viewers, subscribers of the channel. But for members, I'll be creating videos this week, probably at a very good pace, and I'll be streaming. No stream tomorrow morning, but I'll be back on the airwaves either tomorrow night, maybe to cover Palantir, or maybe Tuesday afternoon. And then I'll stream with Daryl on Wednesday morning and then on Friday morning. So that'll be the schedule. And that is it, folks. You guys have a terrific evening. And let's see where this market goes here in November. It's been a good year. It's been a terrific year for my portfolio, and I want to keep it going. I'd love to rally into the end of the year. That'd be really cool. Rallying November, December, and just putting a really nice end to this really nice year. So thanks for joining me this Sunday, and thank you so much. Good luck with your investments. We'll see you soon.